Hi, and welcome to this edition of the Options Learning Center. My name is Rick Orford, and I've been a stock and options trader since 1999. And today I publish content for some of the most prominent publications, including Bar Chart. In this video, you'll learn how to sell naked puts and use Bar Chart to get the most out of the strategy. A put option is a contract that gives the holder the right to sell an underlying asset at a specific price, known as the strike price, at or before a specified time, the expiration date, and the buyer pays a premium for this right. A naked or short put is an options trading strategy in which the trader sells or writes a put option without owning the underlying asset. A trader selling an option is said to be short, while buying an option is said to be long. The seller of a put option receives a premium in exchange for the obligation to buy the underlying asset at the strike price if the put option is exercised. Also, a trader selling naked puts must have enough margin to cover the purchase of the underlying security if it's assigned. Here's a sample trade using real data from Bar Chart to help you understand how selling a naked put works. Let's say you want to screen the market for potential trades. Bar Chart's comprehensive platform allows you to screen the market as easy as 1, 2, 3. Let me show you how. First, and if you're not already there, go to barchart.com. Second, click on Options at the top of the screen. And third, go to the Options Screener section and click on Naked Put. The results page will list potential trades and different values in the headlines, including underlying security, expiration, bid prices, delta, and OTM probability. The goal of using a naked put strategy is to generate income through the premium received from selling the put option. And you'll find the current premiums here in the bid column. That's your maximum profit. Probabilities are also very important to know when selling naked puts. OTM probability predicts the likelihood of a trade expiring out of the money. Out of the money means the strike price is lower than the current market price of the underlying asset. An option that expires out of the money will usually be unassigned, which is what you'll normally want. Conservative investors will often target a 70% chance or higher of the option expiring out of the money. You also have at the money and in the money put options. At the money means the strike price is equal to or very close to the current market price of the underlying asset. And in the money means that the strike price is higher than the current market price of the underlying asset. At the money and in the money options will have higher premiums due to them having a higher chance of being exercised. Another way to predict if a put option will expire in or out of the money is by using delta. Delta measures how much an option's premium will change if the underlying asset price moves by $1. For short puts, delta is expressed as a 0 to 1. Conservative traders often prefer a delta of 0.3 or lower, which means an approximate 70% chance of the option expiring worthless. Lower risk, however, results in lower premiums. You may also notice on the bar chart's options chain that delta and OTM probability have different values, and this is because the values are calculated differently. However, OTM probability is more accurate in that it factors in additional values to determine the chances. Now, if you'd like to screen for specific filters, the Set Filter tab allows you to customize your screens and utilize dozens of filters to tailor fit your naked put searches. For example, you might want to screen for potential naked puts expiring between 30 and 45 days from now and have a 70% chance or more of expiring out of the money. And in this case, we have a candidate, Tesla. And with that, here are our trade details. And here's how you'll enter the trade. If you go with this example, you'd issue a sell to open order on Tesla at the $170 strike price expiring July 19th. You'll receive $355 upfront for the $170 strike put on Tesla expiring on July 19th. Let's see how this trade can go. Fast forward to the expiration date, and naked puts have three potential outcomes. They can either expire in the money, at the money, or out of the money. Let's start with the latter. If Tesla's price ends at $195, the buyer has no incentive to exercise the option, which expires out of the money. You, the seller, keep the initial premium of $355 and the trade is now closed. Now, for peace of mind, some traders close their OTM short options before expiration to avoid possible assignments. To close out your trade, you'll place a buy to close order using the same put option with the same underlying expiration and strike price. Now, this will lead to slightly decreased profit depending on the difference between the initial premium that you received and the premium that you have to pay to close out the option trade. Say Tesla drops to exactly $170, the strike price. In this case, the option will likely expire worthless and the trade is over. And finally, if Tesla goes to $150, well, now the option is in the money. It will get assigned, and you will buy 100 shares of Tesla for $170 a share. Now, assuming you don't intend to hold the shares, you can now sell Tesla at the market price. A naked put's maximum potential loss happens when the stock price goes to zero, but that's rather uncommon. To calculate the loss on this trade, take your strike price and subtract Tesla's price at expiration, then subtract the premium that you received and multiply that by 100 for every contract. On this trade, the loss would amount to $1,645. However, if you choose to keep your Tesla shares, you'll only incur paper losses and you'll now fully participate in the stock's price movement up or down. However, since a naked put ultimately means owning 100 of the underlying security upon assignment, and the seller collects a premium, well, you could say that the risk of selling put options is less than owning the stock alone. To calculate the break-even point of a naked put, subtract the premium received from the strike price. In this case, it works out to $166.45. To help you better understand how the trade could go, here's a table showing the profit and loss at different price points, assuming that you'll sell the shares upon assignment. As you can see, any price movement higher than the strike price will not result in additional profit. But if the underlying stock moves below the break-even point, you will incur paper losses. Now, let's discuss the pros and cons of selling naked puts. Selling naked puts can be an excellent way to generate income when markets are moving up. Having said that, selling naked puts is considered a high-risk strategy as you can experience significant losses if the underlying asset's price drops. However, this is similar to owning the stock outright. Selling naked puts can provide traders income from premiums, but that strategy often comes with significant risks if they're not managed properly. Having a successful risk management plan to handle adverse market movements is always helpful. Also, traders should conduct thorough market analysis to support their bullish to neutral outlook and monitor their positions to make informed decisions about exiting or adjusting the trade. Finally, only sell put options on stocks you'd actually like to own, as one day you might eventually get assigned. Using the bar charts option screener and supplementing your trading knowledge through the Options Learning Center can definitely help ensure success in your options trading career.